Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer at Worth Asset Management. We're going to go over your three threes for the week for July 18, 2022. We're going to go over our three top market movers, and they're good ones this week. We got our three favorite and our least favorite asset classes, and how we're positioned on the equity side and how we're positioned on the fixed income side. So let's jump right on in.
Okay, let's go over the top three market movers for July 18, 2022. The first one being CPI. On Wednesday, CPI for June on a year-over-year basis came in at 9.1, which was higher than expectations of 8.8 and higher than May's 8.6 level. If you look down here at the core CPI, came in at 5.9, and again, higher than the last 40 plus years level. So this almost guarantees at the July 27th FOMC meeting that we are going to see a 75 basis point hike. Now, I know there's been some talk about a 100 basis point hike, but Fed Governor Waller came out on Thursday afternoon and basically said, no, we are going to go 75 basis points. And that's why we saw the market turn around on Friday. And as of this morning, Fed futures are up 100 or 200 basis points. So we shall see what happens, but guarantee that we're at least going to see a 75 basis point hike on July 27th. So let's go ahead and take a look at some of the components inside the CPI to see what's making up this number. Overall, the CPI came in at 9.1. We have medical care, apparel, shelter, food, cars, electricity. But if you look down here, these are some outliers here. This is all energy related, and that is the biggest concern over the past year, is because of these numbers are so high. But if you look, energy only accounts for 7.5% of the CPI. Food and shelter account for almost 50%. So it's probably more important to take a look at where we are on shelter, mortgage, rent, etc., and on food prices moving forward to see if we've actually peaked on CPI or if we're going to go ahead and finally start to come down here. All right. So here's an interesting study that was done by Shadow Stats. They went back and said, hey, what if we were to use the 1980 calculations? Where would CPI be today? Well, it would be at 17.3%, which is higher than it was back in the 80s. So yeah, it's not 9.1 that we feel. It's probably closer to 17.3 or some variation thereof. So it's very interesting to see kind of why this feels more than 9.1%. Some breaking news, rapper 50 Cent changes his name to 85 Cent to adjust for inflation. He's going to have a little trouble because he's going to have to rebrand, change his name, etc. But I think he's going to probably get through this just fine. All right, on a serious note, here's number two, the inverted yield curve. Okay, this is when the 2-year Treasury yield is higher than the 10-year Treasury yield. Okay, right now it is negative, meaning the 2-year is above the 10-year. This is actually the second time this year this has happened. The first time was back in March, and it's also at a 20-year low. The last time it happened was November 2000. So in the last 30 years, every time the yield curve has inverted, the Fed was forced to tighten instead of raise. So I'm going to go over this in just a second and why that's important. But even if you go out to the last 70 years, the US has seen an inverted yield curve before every recession. And like I said before, we are definitely in a recession. So is this time different? No, it's not different. All right, let's go over GDP. Next week is going to have some exciting news because we have the FOMC meeting next Wednesday, and they're going to raise interest rates. And then the following day, we're going to get the first version of second quarter GDP. And if you remember back to the first quarter, we were down negative 1.6 for the first quarter. And right now, the Atlanta Fed GDP now has us down 1.5. So again, the textbook definition and a kind of rule of thumb is 2 negative GDP quarters, we are in a recession. Now, there's actually a committee who they pontificate and decide after looking at all the data on whether or not we are actually in a recession. Well, here's the interesting thing that they look at. They look at GDP, which we just went over. They also look at employment, personal income, and real business sales. Well, 3 of those 4 are lagging indicators. So by the time that those indicators indicate that we're in a recession, most likely we'll probably be coming out. So they may not even, say that we're in a recession until months to maybe even a quarter later. But I'm going to say that we're in a recession. All right, let's go over the top 3 asset classes. It is still the US dollar, T-bills, and commodities in the top 3. The bottom 3 for July 18, we have global equities, NASDAQ, and back in the bottom 3 are small cap equities. Welcome back, small cap equities. All right, now let's go over how we are positioned on the equity side. We are still in protect mode. We keep hoping that we're going to find a bottom here, but all we're doing is that we're possibly consolidating for the next move. Whether it's up or down, I don't know, but we're going to stay in protect mode like we've been in protect mode since April 14th. And the drawdown is 12% with a peak to trough down 20%. But let's go ahead and take a look at bonds. We are actually looking to nibble on the bond side. Okay, we're not nibbling on the equity side, but we're starting to look for opportunities on the bond side. So now we could possibly add some bonds and then turn right back around and go back to protect mode. We shall see, but we are starting to look, and we're not going to go over the bonds. We're going to keep those proprietary to our clients, but we are starting to look for opportunities on the bond side. But Jim, why are you buying bonds when they are raising interest rates? Good question. Here is the Fed dot plot projections through July 18th. As you can see, next week, they're going to go 75 basis points. In the September meeting, they're going to go another 75. It's right now priced at about 50-50. If you go out to November and December, they're going to add another 25 basis point rate hike. But then as we get into 2023, we go to no change. They are going to pause. March 15th, pause. May into June, you're going to start seeing rate cuts, right? And so what that market is telling you, what the bond market is saying, hey, I'm looking 6-9 months out and I see rate cuts. I don't see rate hikes. So you could see interest rates starting to come down and try to front run because you got to remember that the market is a forward looking mechanism. So they're starting to already look for rate cuts heading into 2023. Here's a little interesting side note. The Fed has cut rates during every recession. So if we are in a recession, even if inflation is still high. So in 1974, in 1980, 1982, the Fed cut rates even while the CPI was above 10%. We are right now at 9.1. So it is not out of the norm for them to cut even with inflation being high. Okay, let's head to the board to go over how do you win in a bear market, part 2.
Okay, let's go back to the board and how do you win in a bear market, part 2. All right, This graph is a representation of a 10-year period looking at the MSCI EAFE index, which is the S&P 500 for international stocks. Okay, we went back through 2000 through 2010, and yes, the market dropped down and it went up and it dropped down and it went up, but basically the return was a meager 5.6% return. It was really considered to be a lost decade for international investing. So what we did is that we went ahead and did this study and we started to go inside the numbers. And so we're going to use a little bit of statistics. So I hope I don't lose a lot of people here, but this is what's called the normal distribution or bell curve. Okay, so you're going to have all these expectations or observations within that 10-year period are going to fall on this graph. 2/3 of it are going to fall within this period here. They're going to be small winners and small losers. You're also going to have about a 16% that are going to fall on this large winner side. That was the period from 2003 to 2006 and 2009 and 2010. The other side, the other 16%, you're going to have some very large losses. From 2000 through 2003 was down 31%, and 2008 through 2009, that market was down 41%. So what if I could get rid of some of these large losses, kind of diminish them, mitigate them as much as I possibly can, and just kind of get them out of my portfolio? What ends up happening is I put them up here, but I start to return that 5.66% return that you had if you bought and hold during that period changes to a 91% return. So instead of a decade where I lost actually or made no money, I actually now almost doubled my money. So avoiding these large losses or this weakness in your portfolio is so important to the return of your portfolio. Okay. So let's recap again. I want to hold on to that strength, and I want to avoid and I want to cut and sell those losses in my portfolio. Now, I know I went over some of these examples last week, but I added a few more: Coinbase, Bitcoin, Shopify, NASDAQ, small caps, etc. I want to, again, eliminate those as fast as I possibly can out of my portfolio, because these are the things that drag down your performance and drag down your overall returns in your portfolio. Okay, so we want to eliminate that weakness as fast as we possibly can out of our portfolio, because I can always buy them back at a later date. And I'm going to show you a couple of examples. Okay, you may have heard of this company. It's Intel. I actually went back from 2000 through today for Intel. Now, during the dot-com period, Intel dropped 90%. 90%. Okay? Through 2008, it dropped another 67%. And it took 17 years until that mark got up to where it was at its peak. 17 years just to break even. And it shot above, and it's actually through yesterday or Friday, it's at $38.71. So it's actually below again where it was 22 years before. Let's look at another example. Cisco. This was the Google, the Amazon, the Facebook, the Microsoft of the day back in the dot-com era. It also dropped 90%. Again, 90% in your portfolio. And then it dropped another 60%. And guess what? It took 22 years to get back to even. And as of today or through Friday, 42.60 is Cisco. So it's below its peak. So you made no money over 22 years if you bought and held Cisco. So where are we today in Cisco, the market? Are we here? Are we here? Are we here? Where are we? How long is it going to take for some of these stocks that are pulling down your portfolio to get back to even break even, right? This market has trained us to go ahead and buy the dips. Well, we're not in buy the dips anymore. So you got to be very careful, and you got to eliminate these type of stocks out of your portfolio as fast as you possibly can. That's it. Thank you for joining us. Our next update will be Monday, July 25th. Please don't forget to subscribe or watch one of our other videos. And thank you again for joining us. We look forward to seeing you next week. Thank you.